Canadians have this advantage where they could leave the country and they are only taxed on where they live. Unlike the United States,
Hello amazing viewer, welcome back to another collection of TikTok videos, and this video I'm so excited to share it with you. It has a lot of information about taxes. It's a kind of comparison of taxes rate between the US and Canada. So if you're a resident or if you want to migrate into one of these countries, these are the kind of things that you should put into consideration and make a wise decision on whether to settle in the US or in Canada. Yeah, I'll let you enjoy the rest of the video. Please kindly subscribe, comment, and also share the video.
But isn't it crazy that in Canada earning $50,000 is better than earning $51,000? What? That is not how it works. Yeah, it is. You get taxed 15% federally up to $50,197, and once you pass that, you pay 20.5% tax. Man, I am telling you, that is not how it works.
Canada versus US in terms of tax. Well, the US focuses on businesses, Canada focuses on the individual. Canada has a simpler tax code than the US, which can make it easier to file tax returns. However, the compliance rate is higher than the businesses that the US tax system uses.
Congratulations, here's a pay raise. Your total income is going to be $52,000 a year. I'm sorry, but I can't accept this. Do you not like money? I totally understand, but I'm at the 15% federal tax bracket. If I make more than $49,020, I'll be taxed at 20.5%. That means I'll make less money. Come on, man, that's not how our taxes work in Canada. Huh? What? What do you mean? In Canada, we have a progressive tax system. That means you're taxed within brackets. Thus, in your scenario, you're only taxed 20.5% on any dollars above $49,020. Therefore, the initial amount is still taxed at 15%. Oh, this system makes way more sense. Thus, I should always accept a raise? 100%.
If you don't know how taxes work here in Canada, you can watch this video because I'm going to tell you everything you need to know right now. For this example, we're going to use Alberta, but the numbers are very similar across Canada. So we have three main types of tax here in Canada. The first one is dividend taxes, the second one is capital gains, and the third one is other income. This includes interest in high interest savings accounts, as well as your salary or your hourly earnings, anything that is not a capital gain, which is making money on an investment, or a dividend, which is receiving money as a payment for holding the share. So for most people, the majority of their income is going to fall into this other income category. Now, when it comes to paying taxes on that income, the first $53,359 of that income is going to be taxed at 25%. Now, the money that is above $53,359 but below $106,717 is going to be taxed at 30.5%. So this means that the more money that you make each year, the higher taxes you are going to pay, but you only have to pay that higher tax bracket on the amount of income that is within that bracket. So now when you figure out what tax bracket your income goes up to, that is going to be your marginal tax rate. And then when you take your total taxes paid divided by your total income, that is going to give you your average tax rate. If you live in Alberta, our tax rates go up to 48% on every dollar you make above $341,502. The system is designed so that if you earn a lower income, you are going to pay a lower percentage in taxes. But if you earn a high income, you are going to pay a higher percentage of that income in taxes. A couple ways that you can pay less taxes are by contributing to your RRSP to reduce your taxable income, investing through your tax-free savings account to reduce your capital gains tax, and by buying your first home using the first home savings account so that you can get both of those benefits. Now, when we start talking about capital gains here, let's put an example to it. So let's say you buy Apple shares at $100 and you sell them at $200, you would now have $100 in capital gains. Those capital gains get added onto your taxable income, so they get added onto your income at the end of the year, but they only get taxed on 50% of the capital gains, which is why you'll notice that these tax brackets right here are always 50% of the other income tax brackets. So let's say that you made a lot of money and you're in the top tax bracket here and you made $100 in capital gains, you would have to give $24 of that back to the government in capital gains tax. Now, the dividends start to get a little bit more complicated because it depends on what country they're coming from, as well as whether or not they're eligible or non-eligible. So if you want to see a full video on that, I'll probably have to do it separately. Leave a comment down below.
The taxes that I pay in Canada definitely come back to me. You see this thing right here? You see what she used to be? She spent a whole week in the NICU when she was born. She almost died when she was born.
You want to know how much money we were charged to keep her alive? Nothing. You want to know how much it would have cost to keep her alive in the States?
Generally, the US system is more efficient. Now,
Well over $50,000. That doesn't even include the cost of birthing her, or the EI that my wife got for her when she was on a year of mat leave, or the reduced daycare costs, or the Canada Child benefit that we're getting. Now, you might be saying, I don't have a kid. Who pays for your roads? Who pays for your garbage collection? How do your goods get transported? What about schools? How are you educated? If you went to university, that was still subsidized. Same thing with college. The issue is tax and spend. The issue is tax and spend, and they never give back. Woe is me. I live in this great country that's been ranked as one of the best places in the world to live on virtually every single metric, and all I do is get taxed, and I never get anything back. Like, you guys realize what you sound like, right? There are people in countries all over the world, billions of people, who are desperate to live the life that you live. And the life that you live is possible because of the taxes that you pay. So do your part and pay your taxes so that kids like her can live.
Now, value is the next metric that we look at. The value of the tax system depends on the needs of the government and the taxpayers. Both Canada and the U.S. use a progressive system, meaning the more the more income that you earn, the more taxing you pay. Various tax rates federally. Canadian taxpayers have a higher tax burden, but Canada also has more social programs and benefits, such as universal health care and a stronger social safety net. Finally, the benefit to taxpayers. Canada has a more generous system of tax credits and deductions for individuals, such as the child tax benefit and assistance to low and middle income families. In contrast, the U.S. places a greater emphasis on tax breaks for businesses, which may benefit some taxpayers indirectly through job creation and economic growth. So what do you think? Which country is better? Leave a comment and let's discuss.
Then how does it work, wise guy? In your example, that first $50,197 would be taxed at the federal rate of 15%, and then every dollar over that would be taxed at 20.5%. It would look something like this. Maybe I should follow you instead of listening to my coworkers.
Like, if I'm in the US and I'm a resident of the US, I'm a citizen of the US, and I want to go to Thailand and work full-time from there, I'm still gonna have to pay tax to the United States, okay, no matter where you go. But in Canada, you're only taxed on where you live at the time. Canadians basically have life on easy mode.
When we do taxes in Canada, there's a couple different steps that we want to get. Number one, we're going to take all of our different sources of income. So all of our T4s, any T4As that we have, if we had EI during the year, if we took money out of our RSPs, rental income, self-employment income, all of that income, and we're going to add it into one number. That's our total income. Then what we do is we take off deductions. Deductions are going to be things like childcare, money that you contributed to your RRSP, employment expenses, if you had to work from home because of the pandemic. All of those get added into one number for deductions and subtracted dollar for dollar from your total income. And then that number that they create is your taxable income. Now, based on your taxable income, the government will say this is how much tax you have to pay federally, and then in your province, you'll figure out how much tax you have to pay for that amount of income in your province. Next step that we have is to add up all of our different credits. So everybody in Canada gets basic personal amount. If you paid into CPP and EI, you'll get those credits. If you're an employee, you'll get Canada employment amount. And there's a number of other credits for donations, medical expenses, things like that. If you want a full list of all the deductions you can claim and all the credits you can claim, if you click the link in my bio, I have a free guide for you, and it is literally every single one you can claim. So I highly recommend you get it and look through it. Once you have all those credits, you're going to add them all up. All the federal credits, you're going to multiply by 15%. All the provincial credits, you're going to multiply by your provincial credit rate, which is the lowest tax bracket percentage in your province or territory. Then you're going to take your federal tax payable, which was based off of your taxable income, and you're going to subtract your federal credits after that 15% from that number. So let's say, for example, based on your income for the year, you have to pay the federal government $2,000, but you have federal tax credits of $1,000. You would take $2,000 minus $1,000, so you'd really only have to pay them $1,000. You do the exact same thing with the provincial credits and subtract them from the provincial tax amount that you would owe. After that, once you subtracted the credits from the federal side and the credits from the provincial side, you're going to add up the remaining tax payable from the federal government and the remaining tax payable from the provincial government and add them into one number. That's called your total tax payable. Last step, you're going to look at on your T4 slips and all your other slips how much tax was already deducted during the year. This is usually in box 22 on all the slips. And then you're going to say, okay, based on my total payable, the government says I owe the province and the federal government, let's say $3,000, but during the year when I add up all the tax that's already been deducted off all of my paychecks, I've already paid $2,000, so I owe them an extra $1,000. Or the opposite happens and you get a refund if the amount of tax you've paid already during the year is greater than the amount of tax in your total payable that the government wants you to pay. Does that make sense? And lastly, because it's your first year, you also have to fill out the immigration worksheet with your income before coming to Canada and your entry date. Hope that helps. Follow for more tax tips.
Canada sucks, especially Ontario. I don't know why anyone wants to move here. Look at our tax brackets. It's actually stupid. Let's say you made it. You got the ultimate promotion, you worked your ass off. You're now making 100 grand a year. You're not, because almost half of it goes to the government. So realistically, you're bringing home 60 grand a year. Now it gets worse. After you pay taxes, you still got to pay taxes on all the shit you buy. 13% tax on everything. If that's not enough, let's say you want to buy a nice car. Let's say you've saved up for your dream car, Mercedes-Benz, a Porsche, whatever it may be. Well, guess what? There's now a luxury tax. You got to pay either the lesser of 20% of the retail price above the $100,000 mark or 10% of the total vehicle price. Let me rephrase this for you. This is after you've paid taxes to the government with your after-tax dollars, and then you have to pay HST on top of it. So there's 13% on top of this already. Now let's assume you achieved the dream. You bought a house. This is what property taxes look like for me. Every single year, 14 grand each year. And let's say you got to commute to work. Well, guess what? They just increased the carbon tax on a liter of gasoline from 11 cents to 14 cents. So you're now paying a premium, a higher premium than you've ever paid before for gas. Oh, but it gets better. The interest rates are a ridiculous amount. Who the hell is affording any sort of mortgage payments with these kind of rates right now? And this is normal. I always think of that video of Kamala Harris where she says, don't come, literally do not come to Canada. It is so expensive to live here. Everything gets overtaxed. You get overtaxed. Once you pay those taxes, you still pay sales tax on top of it.
Now change. Canada's federal tax brackets have increased by 6.3% to account for inflation. So these are what the new tax rates are. You can go on the CRA website or the CTV News website and find this article. But if you are making between 53K and 106, your federal tax rate is 21%, and it increases as you go up into 33%. I feel like I'm going to get a lot of messages and comments down below saying how they hate taxes. Trust me, I get it. But taxes do help our economy run and our lifestyle. You know, they give us free healthcare. They give us our roads. There are lots of good benefits of paying taxes. Despite all those benefits, I would make sure you look into a tax sheltered account so you can protect your money. The TFSA, the RRSP, these can all help you.
Here's how to write off your wedding on your taxes. My name's Laura. I'm a Canadian tax professional with 10 years of experience, and I do taxes Canada-wide. Doing this, you'll be able to write off your flowers, your decor, wedding attire, and even your food. First, find a registered charity who would like to accept the things that you're looking to donate. Second, purchase all your items and make sure you keep the receipts. Third, after your wedding, donate the items to the registered charity as a gift in kind. You'll receive a donation slip for each item you donated up to the value that you paid for that item, and you can write it off on your taxes.
Here's how to avoid paying so much tax as a Canadian. If you like saving money, listen up. And no, it's not wrong to avoid paying taxes. As long as you do it legally, it just means you understand how our tax system works. Our government offers so many tax deductions. Many of them might be your everyday life expenses. And you can use these to lower your taxable income, meaning you're gonna pay less taxes. So examples of these deductions would be some moving expenses, some medical expenses, and even the interest on your student loans. To learn more about tax deductions and which ones you might be eligible for, Google CRA tax deductions and head to this browser page. And don't forget to do it now, before you file your taxes. Remember, financial knowledge is financial power. And while you're at it, like and follow for more finance tips.
You've watched to this extent and you've not subscribed, what are you waiting for? Subscribe to the channel, you guys, and also share the video. I appreciate your time once more. Thank you so much for watching.